Good day, everyone. A lot of my friends today we'll be discussing about equity index funds in the Philippine context. A lot of my friends are actually been asking me about it. How do you exactly invest in index funds and what are index funds? So I'll quick for today. I'll just quickly show you how I did it, like like example of an actual investment play that I've done from May to August. Okay, so I prepared some short slides to help us with our discussion. So I'll share my screen now. Okay, so we'll be discussing trading or investing in the Philippine Consumption Index Fund. By trading investing, it's more or less synonymous with each other, but in this context, I'm pertaining to trading as to being short term, let's say intraday or maybe day trading or even a week. Investing would be more on the long term horizon, like a month or years. So that would be the context of this, the use of these terminologies. Okay, some more background or investment context for this discussion. Okay, now this case that I'll be discussing is about will illustrate how I actually invested in an index fund. In this particular case, the investment was on a BPI Invest Philippine Consumption Equity Index Fund. This is one of the many unit investment funds, UITF, of BPI Asset Management and Trust Company. Now, the details of the stock components of this BPI PH Consumption Index Fund can be seen in the fund's key indicators and disclosure statement. This is normally called KIDS in the industry parlance. And this can be found in the BPI ANTC website. Okay, most Philippine equity index funds actually track the Philippine Stock Exchange Composite Index, what we know as PSEI. Okay, this is an index of the price level of the 30 most actively traded stocks in the Philippine stock market. These are mostly blue chip stocks like San Miguel, SM, Ayala, etc. So those 30 are supposed to mirror the general trend for the Philippine stock market. Okay, now also in the investment context, we'd like to note that the decision to invest in various types of equity index funds was anchored on the following principles and realities. Now, before I mention that, let me just clarify that there are actually various index funds that you can invest in. The main one would be on the PSEI, and most banks and trust units of banks or even trust corporations of insurance firms and investment companies would have this PSEI uh, equity index fund. Now, BPI would have more index funds aside from the main PSEI index. In this particular case, they actually have the consumption index fund and also the infrastructure equity index fund. Okay, there are some variation. Now, why am I investing in various types of equity index funds? I have two main reasons. One is that there are actually some variations in the movements of the various index funds between the PSEI, the consumption, and the infrastructure. I've actually observed it. Um, like some would be more volatile, some would tend to go higher faster. So, like I particularly like the infrastructure fund. So there are days that it's quite sensitive to the PSEI, but again, this would you would have to note into what exactly uh, goes into the equity index fund. But if you don't want to go into that details, just view it as the general infrastructure index. And then you have a general consumption index. Okay, again, I'm separating it because there are possible variation in movements. And I want to exploit as an investor those variations in movements. Also, okay, my investment timing and horizons for this investment place may be different. So it can be that at this point I have money, so I invest it. Then at some point in the future, I would have more additional money, and then I can invest it again. Now, if I mix those monies, then it will be hard to do independent setting, monitoring, and enforcement of entry and exit targets. Okay. So, for instance, if one of your funds is underwater, then you start money, plow in new money to it. Then it's quite hard to be able to distinguish what's underwater and what can actually be already profitable. So that separation allows new investment plays, even if old plays did not pan out as planned and they become temporarily underwater. So hinihiwalay-hiwalay ko lang para madali yung management. I do not want to do like cost averaging for this one because it kind of helps deviates from the principle I'm trying to do of trying to do disciplined entry and exit for various funds or even for stock market. Okay. Now, for the BPI consumption index, I actually did a play from May to August. So this graph is a graph of the PSEI. I do not have the graph of the consumption index of the BPI because they're the ones who do it, who calculate it, and it's not publicly available. But more or less, the consumption index of BPI should mirror or how do you say track also to a certain degree, will be highly correlated with the Philippine stock index. Now, the point I want to make here is that when did I enter and when did I exit? So I started entering the index for the Philippine consumption index of BPI on May 17. I think that's when there was a dip. Normally, I would buy on dips. Okay, and then I noticed again another dip in 19, so I bought into the market again. Okay, so this is sometime here in May. And then the market still became bad because of the inflation issues and what's happening on in the US. So it still even fell further, and I actually exploited that movement. So I invested again on June 30th. So there were 3 times I plunked in money into this consumer index fund. May 17, 19, and June 13. And then a couple of 1 or 2 months after, I took advantage of the short-term market rally and exited. Okay. Now, did I have a specific entry and exit for this one? Not really in this particular case. All I see is an opportunity. So when I see a dip, if I have money, I see a dip as an opportunity to get a future return. So I would exploit that. So I did that twice in May, or thrice May and in June. And then did I have a specific target exit for this fund? In this particular case, no. I'm playing it by ear. I just know that it will go up. Now, when it was going up, how did I know it was time to go out or exit? I exited because I'm afraid that the economy, there's some challenges that are happening in the economy, like the inflation. It's not very rosy and it's not very good, to be honest. So I'm wary of those economic deterioration and challenges. So I opted to already exploit and take profit on what I already have. Okay. Instead of waiting for a longer one. Okay, and then anyway, I can always use the principal, the original principal, and the earnings from it, and to invest it sometime when there's another major dip. Okay. So this investment play yielded about 8% for me in 3 months. That's not annualized. Okay. that's good enough for me. Normally, I would for investment funds, I would trade it about 10%. If I get 10, I'm quite conservative that way. If I have 10%, I can exit. Or nor or and then normally my investment horizon would be like 1 to 3 to 6 months, maximum 6 months. That's my horizon. Why am I doing it? It can be longer, but for me, that's my position. Why? Because I'm trying to take advantage of the reinvestment. If I have a continuous income stream, like if I'm employed now, I have a continuous income stream, I'll just plunk in money and have longer term horizon. But since I'm relying on earnings of my investment portfolio to pay some of the bills, then I do have a shorter time horizon to take advantage of the profits. Okay. Now, some insights on this index fund. Okay, in my view, as a long-time risk professional and a long-time personal fund manager, I've been doing stocks and managing my fund, and even at one point, the funds of others or the monies of others for at least 20, 30 years. Okay. For me, investing in index fund is actually easier than direct stock trading for the following reasons. One, the risk is actually less because the price swings of the members of this index, which is really nothing but a basket of stocks, actually partially offset each other. Now, that offsetting lessens the risk. In this particular case, the risk is not concentrated on a single stock like you do in a single stock trading or picking. For me, it's also easier to make an investment bet in an index fund. An investor did not study in detail a particular stock or company. He or she just needs to know the expected general trend of the index for his or her target investment horizon. Diba? That's easier. Now, index fund investing may have lower risk and lower yield compared to direct stock trading, but from experience, I think it can still yield considerable returns compared to other investment vehicles like bonds or term deposits. Now, another insight I would like to share is that the decision to invest in various types of equity funds was actually okay. Okay, I think this is a. I'll cut it now. I think the last part is just a repeat of the second one. So so that's basically it. As you can see from my example, you can get reasonable uh, yield from this equity fund. It's easier than direct stock trading, so I enjoin you to actually try it. Now, of course, there are risks in doing so, so I'd like you to do your own research. I'm not uh, endorsing any particular fund or institution, but I'd like you to try this type of investment as something that you can consider in your portfolio. Okay? Thank you, everyone. I hope you learn a thing or two from this discussion. If you have comments or suggestions, just let me know in the comment section. Thank you very much.